All right, let's jump right in. What if I told you there was a way to pinpoint the exact moment a market trend shows its hand, confirming it's about to continue with some real force? Well, that decisive moment is what we call a break of structure. And honestly, understanding it is one of the keys to reading what the market is really trying to tell you.
But before we even think about a chart, we have to start with our mindset. This quote from the legendary trader Ed Seykota says it all. Good trading isn't really about finding some secret, magic entry signal. It's about making sure you survive to trade another day.
And this right here gets to the absolute heart of it. Amateurs get obsessed with being right, always hunting for that one single perfect entry. Professionals, they're obsessed with not being wrong in a big way. It's all about playing defense first, because they know protecting their capital is the only way to stay in the game long enough to win.
So that leads us directly to the bedrock principle of all successful trading. Before you learn any strategy, before you do any analysis, you have to master this one non-negotiable rule. You preserve your capital. This is what turns trading from a short-lived gamble into an actual career.
Think of it like this. Your trading strategy, your edge, needs time and room to work. Solid risk management is what gives it that space. Without it, you could have the best strategy in the world, but one or two bad trades could just wipe you out. Capital preservation is the foundation you build everything else on.
So, how do the pros actually do it? Well, it all starts with position sizing. The golden rule is to only risk a tiny, pre-decided percentage of your total capital on any one trade. We're talking just 1 to 2%. That way, no single loss can ever cripple your account.
Okay, so we've got our defense locked in. Now we can start learning how to read the offense, how to read the market's playbook. And that all begins with understanding market structure. You can think of it as the fundamental language of price action.
So what is market structure really? In the simplest terms, it's the market's DNA. It's that repeating pattern of peaks and valleys, of highs and lows, that tells us who's really in control. Is it the buyers or the sellers? It's what reveals the underlying story of the trend.
And this DNA really just comes in two main flavors. You've got an uptrend, which is just a series of higher highs and higher lows that shows us consistent buying pressure. And then you have a downtrend, which is the complete opposite, a series of lower highs and lower lows. That's a clear sign of selling pressure. Simple as that.
Now let's take a look at what this looks like on a real chart. You can literally trace the story right here. See this uptrend? Notice how each new peak pushes higher than the last one, and every time it pulls back, it finds support at a higher level than before? That rhythm, that step-by-step pattern, that is the exact structure we're looking for.
Okay, so we've spotted a trend. That's great. But how do we know if it's got the juice to keep going? Well, that's where the break of structure, or BOS, comes into play. This is the signal that tells us the current trend still has momentum.
So a break of structure is just a confirmed move that pushes past a previous high in an uptrend or a previous low in a downtrend. It's the market basically showing its cards and saying, yep, we're still headed in this direction.
But here's the million-dollar question, the one that trips up so many traders. You see the price poke through a key level, but is it a genuine, real break, or is it just a trap? Getting this right is absolutely everything.
And here is the single most important rule for telling the difference. A real break is confirmed when the candle body closes past the level. If only the wick pokes through, that is not a confirmed break. That little wick is often just a quick hunt for stop losses before the price snaps right back. So remember, a body close is a signal, a wick poke is just a warning. And these two charts show the difference perfectly. Look over on the left. See how that red candle's body closes firmly below that previous low? That is a valid, confirmed break of structure. Now look at the chart on the right. See how the price only stabbed below with its wick, but the body closed back inside the range? That's a fake out, an invalid break, a classic trap.
Okay, so now we know how to spot a valid break. The trend is confirmed, so we just jump in right away, right? Whoa, not so fast. The professional's playbook is all about patience, not chasing the market. Here's the thing. Professionals know that after a level is broken, the price very often comes back to retest it. That old resistance level becomes new support, or that old support becomes new resistance. That retest is your high probability entry point. It's the market confirming that the level has officially flipped.
So let's lay out the game plan, step by step. First, you find the main trend on a higher time frame, like the 4-hour or the daily chart. Step 2, you wait for a confirmed break of structure. Step 3, and this is the hard part, you patiently wait for the price to come back and retest that broken level. And then finally, you can drop down to a lower time frame to pinpoint your exact entry, lining everything up perfectly.
All right, we have the ideal playbook. But it's just as important, maybe even more important, to understand the common traps. Sometimes knowing what not to do is the most valuable lesson of all.
And if we look at the data on the most common trading mistakes, a very clear pattern emerges. The number one error, by a long shot, is jumping in too early, a premature entry. That's followed closely by just misidentifying the structure in the first place, and of course, letting your risk management rules slide.
So let's just make a quick checklist of the big pitfalls to avoid. First, don't trade every tiny little break you see. Context is everything. Always respect the trend on the higher time frame. Never jump in before you get a confirmed retest. And please, never mistake a wick for a real break. And above all else, never forget your risk management rules.
And that really brings us to the final, most important question you have to ask yourself every time you're about to place a trade. Successful trading isn't about frantic reactions. It's about seeing the structure, waiting patiently for the signal, and then executing a disciplined plan. So are you just reacting to all the noise, or are you executing a patient plan?